Hello traders, and welcome to the very first video of a video series that I decided to call Snail Traders Practical Guide to Trading. Being in this business for about a decade now, I have seen a lot of courses, a lot of websites on the internet that try to educate people into becoming financial traders, but what I believe that they lack, all of them, is practicality. You browse all those websites, you read a ton of information, and I must admit that you acquire a lot of knowledge, but when it comes to when you start trading, you start to feel like you don't know where to start. This is the thin line between education and practice, and with this video series I am to provide you with exactly this. I will try to help you put all that knowledge into practice. So, enough talking, and let's get into the first subject. Unlike other courses, which usually start with some basic concepts of technical analysis and then move into more complex subjects, I decided to take a completely different approach. I will start this video series with a concept called money management. This is a concept that to me is very important, and it is usually overlooked by all those educational resources on the web. Money management, as the name implies, refers to the techniques that traders use to manage their capital. Most novice traders are interested in ways to increase their capital, while they do little to maintain their capital. Unfortunately, this is a completely wrong way of thinking. So let's do this right. Every not lost dollar is profit. I'm going to say that again. Every not lost dollar is profit. It sounds odd, but think it this way. Imagine you lose $1. That's a loss. Since profit is the opposite of the loss, a dollar that is not lost is profit. What I'm trying to say is that it is extremely important to value our capital. It is extremely important to appreciate what we have. It is extremely important to minimize losses. In our life as a trader, our target number one is to maintain our capital. Increasing our capital comes after that. So let's open a spreadsheet and throw some numbers in it. So this is an empty spreadsheet, and I'm going to use it to make a few calculations. But before I start, I would like to use an extreme example to show you what I was saying before, how important it is to protect our capital. Imagine we have a new account and we deposit in it $10,000. So the account balance will be $10,000. Imagine now that we are planning to place a trade and we're willing to risk 50% of that account on that trade. Imagine now that we lose that trade. That trade will be $5,000 and this will be a loss, so our new balance will be our initial balance minus the loss. Our new account balance is now $5,000. In order to recover the losses, we need to earn $5,000. However, looking at it from the dollar point of view does not reflect the catastrophic consequences of using such a high risk. And in trading, we have to think in percentages rather than in dollar amounts. What I'm trying to say here is that in order to recover our losses, only to regain our initial capital, we need now to make a 100% increase of our existing balance only to recover the losses. Look at this. 5,000 is our current balance, multiplied by 100%, $5,000, and now this plus this is again where we started. We lost 50%, but we need 100% increase, 100% win in order to only to regain our initial capital. Do you understand now why it is so important to protect our capital? I'm sure you do. Now that the importance of capital protection is perfectly clear, we need to see what we can actually do to protect our capital. Financial trading is a game of winning and losing. And while winning trades are always welcome, we must prepare for the losses. Winning trades and losing trades tend to occur in streaks. With regards to capital protection, we are only concerned about the losing streaks. That is, the number of potential consecutive losing trades. This number may greatly vary depending on several factors, such as our strategy, our frequency of trading, our time frame in which we trade, and several more factors. But as a general rule, we can assume that it is unlikely to have more than 100 to 120 consecutive losing trades. So let's clear this. Assume 120 trades, consecutive losing trades, that is. So we divide our capital by those, and we see that we are allowed to risk on each trade $83.33, and if we risk that much, it is highly unlikely that we are going to burn our account. So as I already pointed out, we need to think in percentage points. So we divide this number by our capital, and we see that a good percentage point of our account to risk on each trade is actually 0.80 to 1%. Of course, this is not a rule. This is a guideline, and if you have some trading history on your account, you can go through the statistics and see what was your maximum losing streak. Multiply that by 2 or more for safety, and then calculate your own percentage. Risking this much on each trade makes it a lot more difficult to burn your account than losing higher percentages, as I saw in the example before. In order to make this more clear, let me create a series here. I'm gonna delete this. Okay, so I'm gonna risk 0.8%, okay, and that will be
our initial capital multiplied by this, and then our initial capital minus this, because I'm looking for losses, and I'm gonna keep this constant, and I'm gonna drag all those low, and you see here that because our initial capital is decreasing, as we keep this percent constant, the actual amount that we're risking is getting smaller. Therefore, with that in mind, you will see that in order to burn our account, we need much more than 120 trades. I'm giving here 220, and you see that we still have money. I'm going to drag it all the way down to see the actual number. And we go on. And you see that we can actually continue losing, constantly losing one after another trade without winning any trade, and not burn our account after more than 600 trades. Of course, $50 out of 10,000, it is obviously a burnt account, but also it is quite unlikely that you're going to have more than 600 consecutive losing trades. Now that we have a basic idea of how to protect our capital, I would like to introduce you to two important terms: the win-loss ratio and the risk-reward ratio. Traders use those two ratios to refine their money management technique. In order to increase your win-loss ratio, you have to take high probability trades. But because this is a subject that will be covered in the following episodes, for now we are going to assume that we're going to take trades based on pure luck. Pure luck is considered to be to have a win-loss ratio of 100%. That is because we consider luck a 50-50 probability for an event to happen. So we have 50 trades will be winners, 50 trades will be losers. Our win-loss ratio will be 100%. Even if we trade based on pure luck, which of course it is something that is not recommended, we can still construct a money management technique that will allow us to become profitable over time. And that is by using the risk-reward ratio. Some traders consider acceptable a risk-reward ratio of 100%. Just to clarify here that although we call it risk-reward ratio, it is actually reward-risk ratio, because we divide the reward by the risk and not vice versa. But that doesn't make any big difference to the point that I'm trying to make here. Some traders consider a 100% ratio, risk-reward ratio, is acceptable. Personally, I believe that the minimum should be 200%. That is, when you're willing to risk 100 pips, you must be looking to get 200 pips as a reward. The reason for that is that if we only accept a 100% risk-reward ratio, we are going to win money only if we have a higher win-loss ratio. And if we have a large losing streak, because of the decreasing capital, the decreasing balance of our account, that will become even worse. So we're looking to get at least twice the amount of pips, twice the amount of dollars that we risk on our trades. This way, when we lose one trade and then we win the second one, we're going to make a profit. And over time, that will result in a profitable account. As long as we have, like we said before, we're working with very small percentages of our account, and we are allowed to have very long losing streaks. Over time, using those percentages here, we have a high probability to end up with a profitable account. But because this video series is called A Practical Guide to Trading, and so far I have been only teaching you theory, let's go ahead and do some examples. In order to follow this example and the rest of the examples that I'm going to make in this video series, you need to have a working installation of MetaTrader, either version 4 or 5. In this particular case, I have MetaTrader 5. So far we talk about percentage points of our account, we talk about risk-reward ratios, but we know that when we try to apply this on our trading, it is extremely difficult to do it by heart, or with a pencil and a paper, or even with a calculator. So we need some special software that will give us the exact numbers, and it will calculate our position size that will correspond to those percentages that we're interested in. So there is a website called Earn Forex. It is not related to Snail trading, but there are some useful stuff in there. And one that I use is the position size calculator. You go to Forex Tools, position size calculator, and then you scroll down and find this downloadable MetaTrader indicator, and then you scroll all the way down until you find where it is. Here, by the way, are explanations of the indicator and how it works. And here we are, downloads. And there is a version for MetaTrader 4 and a version for MetaTrader 5. Download the one that corresponds to your version and unzip the file somewhere, and then go to your MetaTrader platform, right click on indicators. It's not gonna happen like that. Okay, you will have to open the editor. You will have to open the editor. Then go to indicators and open folder. This will open the folder where the indicators are. Copy the extracted files into this folder. Then restart the editor like that. Go to this file, MQ5 or MQ4, depending on the version. Drag it in here. Not gonna work with the drag, you have to double click it, and then click compile. I have already done it, so I'm not gonna do it again. Click compile, and that's it. Then close everything, restart your platform, and the position size calculator will appear here. Open the chart of the instrument that you want to trade, okay, and drag the indicator in it. click OK, and you will see this window up here. So now we can use this indicator to easily calculate the right position size for our trade in order to risk the wanted percent of our account. For example, here I have a demo account with $1,000 in it, and I'm going to risk 0.80%, as we discussed previously, which represents $8. It is automatically calculated. And now I'm going to try to place a trade. I'm going to go into the 1 hour chart, and I'm going to try to place a trade with a stop loss at this low here, which is this one. I'm going to set my stop loss, okay, 1.1160, and this is of course from current prices. It is 71 pips, 72 pips, so I'm looking for a risk reward, excuse me, as I said, at least 1 to 200. So I'm going to place here a take profit which is higher than this by 140 pips. So it will be 11, excuse me, not 11, it will be 12. It will be 113. Okay, and we can see here I'm doing something wrong. Okay, 113.70. Okay, and we can see that as I did right now, if we make mistakes with our calculation with pips, this indicator visualizes our trade, our expected trade, and it makes it a lot more easier for us to see what we're doing. So I'm risking 70 pips for 140, and I'm risking 0.8% of my capital. And now all the calculations that I was talking about in the previous part of this video are made easily just with this indicator. So it is easy and practical. And so far, with just this indicator and this platform, we can put into action the whole video so far. The calculator will now calculate for us the respective position size that we have to use in order to risk only that amount. This is our input, and this is the actual result, because position sizes are limited to mini lots, and therefore the actual risk will be 0.72 and not 0.80. So but pretty much close to this, and our money management technique works pretty good. So now we can just click F9. The order window will appear. We're going to set our position size here, 0.01. We're going to set our stop loss like we have it there, and our take profit, 113.70, and we will just click buy. Click OK. We're good to go. Easy, practical.
I hope you found the first episode of the series interesting. Of course, money management is a huge topic, and I barely covered 10% of it. I will definitely come back to this in the future, when you will be able to follow me on more advanced parts of it. Thank you very much for watching.